Welcome. I'm Kara Griffith, the President and CEO of Tax Analysts. We're very pleased that you've joined us today to discuss the current legal debate over Section 1402A13 of the the Internal Revenue Code and the proper interpretation of the term limited partner. It's a mouthful. This debate began decades ago, but it has become an especially high-profile issue today, with cases on 1402A13 now before multiple federal appellate courts with the potential for a circuit split, which is why we thought it is a topic worthy of discussion. Today's event is another in Tax Analyst series of public discussions that we call Taxing Issues. We launched this series as another way for tax analysts to encourage debate on tax issues. We've been bringing the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy and administration. As always, we welcome your feedback on how we can make our webinars more useful, as well as your suggestions on future webinar topics. You can send your feedback and suggestions to events@taxanalyst.org. Today's event is actually the result of a viewer suggestion. We also welcome your questions for today's event. Please use the chat feature to submit questions during the webinar. For our panel discussion, I will begin by asking a few questions, and then I will turn to questions from you, our audience, and I promise to get to as many of them as time permits. For those of you who would like CPE credit today, please be sure to participate in the program for at least 50 minutes and answer at least 3 of the poll questions that will appear throughout the webinar. They will appear on the right side of the viewing window above the comment section. To receive credit for your answers, you'll need to register with Pigeonhole, our interactive Q&A system, by providing your name and email. Also, please remain in the default viewing window because you will not be able to see the questions if you expand the program to full screen. The course materials, which we sent out in advance, are also available for downloading under the viewing window. And now, on to the main event. For a little background on the issue. Back in 1954, lawmakers enacted Section 1401A of the Tax Code. Under it, individuals are subject to tax on their self-employment income, and that income generally includes a partner's distributive share of partnership income. But then in 1977, lawmakers enacted 1402A13, which provides an exception to that self-employment tax for limited partners. For them, net earnings from self-employment do not include, and I quote, the distributive share of any item of income or loss of a limited partner as such, end quote. Now keep that phrase in mind, limited partner as such. By the way, what is a limited partner? As it turns out, neither the law nor the legislative history really defines the term. That's another important piece of background to keep in mind for our discussion. Now let's fast forward to 2018. Section 1402A13 began to attract lots more attention that year after the IRS announced that it was launching a quote-unquote compliance campaign related to the section. Around the same time, the IRS reviewed the tax returns of a firm known as Soroban Capital Partners, and it then increased Soroban's net earnings from self-employment by including the shares of ordinary business income allocated to the limited partners because, according to the IRS, they were limited partners in name only. Soroban petitioned to the U.S. Tax Court to challenge the IRS decision, and the court ruled in 2013 that the Section 1402A13 exception depends on the function and roles of the limited partner. In essence, the court used a functional analysis, citing to the prior case Rankenmeyer, saying that a limited partner that actively participates in the business of the partnership, that is, a partner that is limited in name only, cannot exclude the distributive share of income or loss from the partnership from self-employment tax. More specifically, the court held that by including the words "as such" to 1402A13, Congress clearly did not intend the limited partner exception to apply beyond partners that were functioning as passive investors. The court then applied that functional analysis test in 3 subsequent cases, all of which have now been appealed. But this past January, in a case known as Serious Solutions versus Commissioner, a 3-judge panel of the U.S. Court of Appeals for the Fifth Circuit voted 2-1 to overrule the tax court. It struck down that functional analysis test and said that whether or not the limited partner was just a passive investor distributions to a limited partner as such are excluded from self-employment tax. The court ruled that, quite simply, a limited partner is a partner in a limited partnership that has limited liability. Or to put it another way, the court focused on the limited liability and not the function of the limited partner. Now, that's not the end of the story. For one thing, the government has petitioned the full Fifth Circuit to rehear the case. And for another, the First and the Second Circuits are expected to rule this year on other challenges to 1402A13, and they could issue rulings that conflict with the Fifth Circuit's opinion. That in turn would then increase the chances that the Supreme Court might review these cases and issue a final ruling. So, as you can see, we are right in the middle of an issue that's working its way through the courts, and we have a fantastic panel today to discuss where we are and what we can expect as the year progresses. So first, we have Karen Burke, a professor of law and the Richard B. Stevens Eminent Scholar at the University of Florida Levin College of Law. We have Jim Sowell, a principal at KPMG, and we have Walter Schwedetsky, a professor of law at the University of Baltimore School of Law. So Jim, I'm going to start with you. I tried real hard there in like the 5 minutes that I had to get through most of the background, but beyond what I just laid out, what other important information do our viewers need to know? And also, what are taxpayers to make of that Fifth Circuit holding? If you could kind of work those all into one answer, that would be fantastic.
Yeah, Kara, so I think your background was excellent. I want to take a step back and talk about, what are we talking about in the context of the tax? And we've actually got two regimes that I think are relevant here. So we're talking at a high level about a 3.8% tax, and that 3.8% tax is imposed either under Section 1402, which you've been discussing, or the net investment income tax under Section 1411. Section 1402, the SECA tax, generally applies to trade or business income. 1411 generally applies to investment income, but it actually also picks up trade or business income that isn't caught by Section 1402. However, Section 1411 has an exception if you actively participate in the trade or business under Section 469. So if you have a taxpayer who is active under Section 469 and they can take advantage of an exception under Section 1402, then they get out of both of the 3.8% taxes. The primary exceptions for 1402 are the limited partnership exception that you've mentioned, and the fact that S corporation distributive share generally is not subject to the SECA tax. So that's really, I'd say, the hole between the two statutes that people try to take advantage of. So we're going to focus, obviously, on the limited partner exception today. So as an initial matter, there were a handful of cases in the late 1990s up to 2000, and those cases strictly applied state law in evaluating limited partner status in the context of passive partners. Now, those cases were evaluating things like parties with working interest in oil and gas projects. One case was an actual general partnership, but they were passive partners. Nonetheless, all of those cases said under state law, you are not a limited partner. That is a product of state statute, and hence you don't qualify. There was one case, Gamma Farms, kind of interesting. It's a Ninth Circuit case. And there it involved a situation where a partner was styled a limited partner, but they had neglected to file the certificate of limited partnership. The court looked at it and said, you would have essentially been treated as a de facto limited partner and not held subject to, or you would have not been subject to general liability. So we're going to say you were exempt from the SECA tax. Big point here is these cases, 2000 and before, all looked strictly to state law in evaluating limited partner status. We then come to 2011, and we start having cases evaluating new types of entities, LLCs, LLPs, things like that. And these cases all undertook an alternative analysis, and none of the earlier cases were even referenced in these newer cases. So the first case you mentioned earlier, Rinkemeyer, and there the court was addressing the status of an LLP that conducted of an active law firm business. The court noted the ambiguous nature of the term limited partner, and they looked to the intent of the statute under the legislative history, noting that the provision was intended to prevent partners who are not actively participating in a partnership from gaining Social Security benefits by paying the self-employment tax. The court developed what's come to be known as the functional test and provided that partners who were actively participating in a partnership's operations could not qualify for the limited partner exception. We then moved to another case, Castigliola, and there they again addressed active law firm partners, this time in a Mississippi PLLC. The court noted that Rinkemeyer did not limit limited partner status to parties who were state law limited partners. And they said, what we're looking for is parties who are functionally equivalent to that of a limited partner in a limited partnership. Here, they looked at various versions of the Mississippi Limited Partnership Statute and said in each instance, management power over the business was a key factor in qualifying as a limited partner. There, they said these people were active law firm participants. They obviously had management capacity, and they were not eligible for the exception. Just one other case to mention, Hardy. There, the tax court again applied a functional test and held that passive members of an LLC that ran a surgery center could qualify for the limited partner. So all of these cases focused on the nature of the partner's participation in the partnership. And those were specifically in entities that otherwise provided limited liability. So as you said, more recently, we've had the tax court consider the issue in the context of parties who were actually state law limited partners. And those partners were actively participating in the business, albeit through defined roles in the GP entity that was the manager of the relevant entity. The cases, as you stated, were Sorbonne, Denham, and Cirrus. And Cirrus is going to be, as you said, the focus of this. And I know we'll get into a good bit of detail on that in a bit. So I'll turn it back over to you.
Fantastic. Thank you. So Karen, I want to ask you one question, and then we'll jump into the Cirrus case. How much federal revenue is actually at stake here? Either, I don't know if you could give it per year or over the long term, but it would just be interesting to know what the revenue dollars are.
Okay, well, as Jim has said, we're talking about a 3.8% tax, but it may be against a very large amount of income. So what the government says in these cases, and I've not independently verified it, is in the pending cases, there's $500 million of revenue at stake. We decided we'd take a look maybe at something else, which is the prior administration's proposals. This is the 2024 general explanation of the budget proposals that would have expanded Section 1411 to cover that active business income of pass-through members. So both limited partnerships and S corporations. And that was estimated to raise $4 billion of revenue over a 10-year period and probably growing. That proposal did not change the limited partner exception, but it would have treated limited partners, LLC members, and S corporation owners identically. Now, maybe much of that revenue was attributable to this problem in the S corporation sector. We couldn't break that out separately. I think the one thing that's very clear, because there's a lot of S income that does, because the distributive share is not subject to SECA, a lot of it does escape that tax. It's clear, though, that Congress should have re-examined the limited partner exception and the rule for S distributive shares, either when it lifted the Medicare cap in 1993, which is what really infuriated high-income taxpayers, or when it added 1411 in 2010. It did neither, and we're struggling with that issue now.
Yeah, and I will definitely come back to the question of whether we can expect any congressional action. But before that, Walter, let's jump into the Fifth Circuit case. Can can you tell us sort of where we are, what to expect? I'll leave it to you.
So I'm going to just back up slightly, close to a century, and talk about Wyeth versus Hoey. So that's a Supreme Court case that said that that you cannot use state law to interpret federal law. And what was at issue in that case is Section 102, which excludes from income bequest, devise, or inheritance. And what that meant, the court said, was a federal question. State law could be relevant to associated issues like who has standing to challenge a will. That would still be a state law question, but actually what the meaning of a term in a code section is purely a federal question. So it's a pretty short step to say that state law can't determine how federal law is to be interpreted, to saying changes in state law shouldn't change how a federal statute works. And that's a little bit what's been going on, because there's been lots of changes to the limited partnership statutes since 1402A13 was added to the code in 1977. So then jumping forward, better part of a century, to the Sirius case, which is the one everybody really wants to hear about. So that is a decision of, as Kara was saying, of a Fifth Circuit panel, 2-1 to overrule the tax court. Cases were never actually tried in the tax court because they stipulated they'd lose, given the Sorbonne decision that Kara was talking about. At issue was the income of a business consulting firm. It was all essentially ordinary income from services. They allocated all of it, the limited partner interest. It's also clear the limited partners ran the partnership and provided the services. So this is about as clear cut can you use limited partners to get out of paying your Social Security and other secret taxes as possible. This is sort of the maximalist approach. And the court actually ruled for the taxpayers and said that the core issue is limited liability. Whether the interest has limited liability or not, that's what makes a limited partner. The difficulty with that holding is, and it was, by the way, that was the view, as the court noted, of the IRS for many years. Up through, I think Jim was talking about this as well, up to around late 90s, that was kind of the view. Of course, since the mid 90s, when LLCs came on, LLPs and triple LPs, the whole universe has changed on the ground. So that may explain why the Fifth Circuit didn't restrict itself to the limited liability argument. There was the core holding of the case, no question, but then in dicta, it sort of came close to saying state law controls. It didn't say it in so many words, but it said the answer to this federal question, however, largely depends upon state law. That's because limited partnerships are creatures of state law, not federal law. So it kind of has two lines of reasoning in the opinion. One, just about limited liability. That's a problem. As Karen was pointing out to me at one point, in a triple LP, the general partner has limited liability. So we need something else. And so I think that's what drew the court into this sort of saying, well, maybe it's more about the state law. So that no one I knew thought that Sirius wouldn't overrule the tax court, given other Fifth Circuit jurisprudence. It's not the most rigorous decision. You read through it. And so even people that support the holding, I think the court got to the right conclusion, wish for a more rigorous opinion. It never cited Wyeth versus Hoey. It did cite a case called Kraft, Supreme Court case in Kraft, but that involved a tax lien that would apply to state law property rights. And so then you have to look at state law, of course, to figure the property rights out. It did make, which actually is quite an important argument on guaranteed payments. So 1402A13 says, not something to seek except that you pay guaranteed payments to limited partners. And so that does sort of suggest, well, it sort of contemplated limited partners being involved in the affairs of the partnership. The difficulty with that argument is that at that time we had either the 1916 Act, the Limited Partnership Act, or the 76 Act. And in both of those, the limited partners pretty much had to be passive. And so even if a limited partner, say, were a employee of a corporate general partner that ran the day-to-day business of the partnership, there was a risk under some case law of liability. So even though limited partners could perform services in 77, they were limited on what they could, pretty clear they were limited on what they could do, had to be on the periphery of the partnership. It didn't seem to bother the court that the taxpayers paid zero self-employment taxes. I have a bet with Karen that, so they haven't applied, as you said, Karen, for in-bank review. So I have a bet with Karen that they'll grant in-bank review, and Karen says they will not grant in-bank review. I'm most likely going to lose that bet. The only reason I think it's possible is because A, the opinion it could be tighter, and B, it's going to get a lot of play. It's an important case. It'll get a lot of attention, and so it's like I think it raises the odds from 0 to 5% getting in-bank review. So I'll turn it back over to you, Karen.
Excellent. I mean, you would think it's not a very, as you mentioned, it's not a rigorous opinion. It would have been nice to have maybe a better set of facts, particularly if now we're going to have a split, and this might be attractive to the Supreme Court. Before I move on to the next question, I just wanted to give Jim and Karen an opportunity to respond on the Fifth Circuit.
Yeah, I was going to weigh in just a bit. So it's interesting because, Walter, on your point on federal law or a federal law relating to what is a limited partner, they definitely do give lip service to that. And they also say specifically the relevant federal law the relevant law is the law as of the date of enactment. Yes. Of the provision. So it does seem to indicate that you're looking back to 1977. However, the court then does go through an analysis and a footnote late in the decision talking about, okay, would they have qualified for limited liability? Would their management of activities have put them over the edge? But they seem to then look to current law for purposes of analyzing that, which I thought was a little bit inconsistent in the opinion.
Yeah, I think lip service is a good way to put it, Jim, that they did talk. I mean, there's the one case actually of all the three that are in appeal that really in a significant way talked about federal versus state law. But it was a pretty squishy discussion, as Jim was saying. They said they absolutely gave it lip service, but whether they actually applied that rule is more of an open question.
Can I break in? Because I think this is exactly where I was going to go with state law development, and it allows me to make it a little bit more pointed and to argue in favor of Walter's bet that they should at least grant in-bank rehearing. The question is, what was the nature of a limited partner in 1977? That is what all the courts have agreed on. Okay, and we could have a different standard, but that's not the standard being applied. And in 1977, I think it is absolutely clear that a limited, although the term has always been ambiguous, admittedly, it is absolutely clear that a limited partner had to have both limited liability and lack control. Because if you had control over the partnership's business, then under ULPA 1916, which was still in force, you would have lost your limited liability status. So what I wanted to do, what happened in Sirius, it was kind of battle of dictionaries. The majority read the first part of a dictionary definition of a limited partner, and it said it's a partner with limited liability. It forgot to read the next entry, which is for a limited partnership, which is a partnership in which the limited partners do not run the business, okay? So I think both of those, it's limited liability and lack of control. And so in 1977, I think that much was clear. And I'll mention a little bit later on, if I don't, I'm going to just mention it now, a tremendous article by Sheldon Banoff on sort of back from 1979 on sort of origins of the limited partner definition toward an operational definition of limited partner, which was kind of a huge source for me. But that's a contemporary source, and that's why I think it deserves an awful lot of attention, and nobody seems to have looked at it, mainly. So in 1977, when this statute was enacted, ULPA 1916 was still a law. ULPA 1976 had been proposed, and it was going to modify that control standard a little bit, but it had not yet been adopted by any state. Now, the battle back then was, can I delegate the authority to run the business to a limited partner? And the almost universal answer was no, even though there was a safe harbor for partners as employees, but that meant like acting as like a third party, just a generally salaried type employee. So the fear then was if we had control, we would flunk. And so business planning was to be conservative and didn't grant limited partners those powers. Interestingly, from the RULPA perspective, they actually considered federal classification issues as a reason to retain the control standard. I won't go into it, but those are the old Kintner regs. And they said, states don't adopt anything until we've gotten a federal ruling on this. Okay, so fast forward to 1985, which is RULPA 1985, that still keeps the control test. But it does something slightly different, and it brings it closer to Delaware law, which we may talk about a little bit later. And bringing it closer to Delaware law says you don't lose your limited liability unless there's detrimental reliance by a third party. That's the convergence, ultimately, of RULPA 1985 and Delaware law. Delaware had that provision back in 1973. State law was not uniform, but it was much more uniform then than it is now. So I think that's enough to say at that point.
Here, just one more point on this. I do think part of the Fifth Circuit's decision focused on the fact that the IRS didn't necessarily come to this with clean hands. They've made a mess of guidance over the years. Congress weighed in on some of the guidance that arguably was rational and said you can't do this. They specifically talked about IRS instructions to the 1065, where they said limited partner is defined under state law and has limited liability. Now, the point was made that that's in the general instructions, not the portion talking about CICA tax, but that portion in the general instructions goes on to say some members of other entities, such as domestic or foreign business trust or limited liability companies that are classified as partnerships, may be treated as limited partners for certain purposes. So going to the point that, okay, there may be points out there where LLC members can be treated as limited partners, but not saying limited partners that are state law limited partners may be treated otherwise. So I think that may have had some impact on the court viewing this through a favorable lens for the taxpayer.
That's a very fair point to
Yes.
make. Jim, I'm gonna stick with you for a second and ask about, I mentioned the phrase, and it's odd when you read it, the limited partner as such. What do you make of that? Does that imply the existence of some sort of dual status arrangement where limited partners can have multiple functions? Or do we make nothing of that as such language?
Well, no, I think that as such language makes a lot of sense, but and the Cirrus court discusses this. The tax court, I think their analysis of that phrase was not rational. But a person can be both a general partner and a limited partner. And the legislative history, that specifically the House report in 1977, made clear that your allocable share as a general partner continued to be subject to CICA, while your allocable share as a limited partner was not subject to CICA. So I view the as such language being your distributive share as a limited partner as compared to your distributive share as a general partner. The taxpayer made that argument, and the majority embraced that argument in Cirrus. The dissent did take issue. I thought in a way that was kind of confusing.
Could I just break into this a little bit there? I mean, I think that all the people who are tax lawyers were upset to see that as such language in the opinion. But stepping back from being a tax lawyer, as such may have meant in the capacity of being a limited partner. And if you think, and I know that's also what you're saying, Jim, but I think if you think of it that way, it's not at all nonsensical. And in fact, I think it can be quite meaningful, in part because back again, in 1977, you could be a dual partner. In fact, you could be that in the 1916 Act, but sorry, you could have a dual partnership interest. But there was another concept, which is a hybrid partner, was a limited partner who overstepped the boundaries and violated the control rule. And that hybrid partner would then have been treated as a general partner for many purposes. In fact, the article I mentioned by Sheldon Banoff goes through, well, there's this new provision about a SICA exemption. Could you avoid this somehow by having, tiny LP interest and a huge GP interest? And that article, I think, concludes, well, no, there's a real risk. As a hybrid partner, you would be denied the SICA exemption. The other thing is, I think back in 1977, there was no such thing as a capital interest for profits. The limited partner interest, they all had to be kind of proportional interests. So it's a very different world from the world we're looking at now.
Yeah, I think if I can just jump in there briefly, that's an important point. So I totally agree with Jim that the service made a mess of limited partner up to about 2000. Though, to be fair, Congress ran interference with some regs that were mostly pretty respectable regs. I've been told that IRS has PTSD ever since that congressional attack. So, but the world is different now, right? When we now have LLCs, LLPs. So to see what the IRS did years ago when the world was different, I mean, the IRS should be able to change as the facts on the ground change. Would be the only response I have. But I certainly agree that it was a mess before 2000 or so. Yeah.
And it's all, it would obviously be helpful if there were any sort of legislative history to go back to, and there's a lack of that. And so then we rely on the IRS to fill in the blanks, and it can be difficult. Karen, I want to ask you one more question, and then we'll jump into the First and the Second Circuit opinions. The Fifth Circuit opinion seems to apply to investment funds that qualify as a limited partnership under state law. So that could have implications for managers. In your opinion, does this mean that investment funds that are taxed as a partnership could use the 1402A13 exception for managers?
Okay, and I'm going to focus on the manager part of that because the investment funds themselves are limited partnerships. Jim alluded to what's commonly referred to as the dual structure in these type cases. I'll take Denim as an example. Denim had a GP, and the LPs were members of the GP. They were not partners of the GP. They were members of the GP, and they were partners in the investment partnership. They were limited partners in the investment partnership. Why were they only members of the GP? Well, because the GP wanted to treat them as its common law employees and to delegate to them under Delaware law the ability to run the business of the investment partnerships. They could not be partners of the GP because a partner can't be an employee of his own partnership. So basically, almost all of these cases do involve a version of the Delaware 1985 law, which has very liberal provisions allowing the GP to delegate all of its authority to the LPs. The argument is, well, gee, I was only an employee. I was only delegated power. I wasn't actually exercising power. So what's really come up in these cases, and I think the government was a little slow maybe to get to this, is, hey, what capacity did you really exercise those powers in? Were you an employee or merely delegated powers? If the structure works, and I think most tax lawyers think it works, we may change that, is as long as the GP has ultimate control, it doesn't matter. I can still take advantage of the limited partner exception. But there's kind of a substance over form argument. These people are really acting as employees and should be taxed under SICA. So it's kind of that's what gets back to what I was saying to Jim, the capacity issue, because I think that is crucial here. And there wasn't anything like this, believe me, in 1977. I think I've read there are like 20 or 30 of these old law cases prior to 1977. I think I've read all of them. There's only one none come even close to this. And you couldn't have done it then.
Yeah. I mean, for sure, the world has changed. Jim, go ahead.
Yeah. I do note from reading the briefs, particularly in Sorbonne and Denim, that they seem to be very careful in delineating the status by which they were operating. So they were very focused on the capacity, I think, both for tax and commercial reasons. That certainly is asserted in the opinions. I know, and I think you've got some discussion of this in the very good article that you've done, Karen, that I know will soon be published, relating to the history of the various limited partnership laws. But there were some cases back even prior to 77 that involved corporate general partners.
Yes, absolutely.
Where parties were trying to impose liability on the officers of the corporate general partner, where they were also partners in the limited partnership. And there seemed to be not consistent decisions in those situations. I know the Texas Supreme Court came down asserting unlimited liability. The Washington Supreme Court said that there was limited liability. So this does seem to be something that back then at least was on the radar of the courts.
But Jim, these guys were simply employees of the general partner. They didn't really have an ownership stake in the general partner. And the reason the Washington case, I think, came out differently was because Washington was one of those few states that had the detrimental reliance standard. There was a slight variation in the Washington law. So you're right, and I think the taxpayers' case called Frigidaire, that the taxpayers have heavily said, Frigidaire is our situation here. I just think, in fairness, it isn't, because there's a lot of language there about saying we don't want to pierce the corporate entity. They didn't control the corporation. So, I mean, I agree.
I will note that the Frigidaire case also relied in part on the fact that that was a corporation that wasn't formed specifically to be a general partner for this specific entity. It did it for a number of entities. So it's not identical. But just making the point that really the law as to limited liability seemed to be hard to define as of 1977.
It was
but for that reason, though, I think if you were advising a client in around 77, you wouldn't tell them to run the partnership as an employee of a corporation, say, because it would be too risky. You would.
There was absolutely risk.
I want to say Jim's point that this has commercial reality, the two-tier structure, and they were very careful to delineate their functions. I may be a little bit, skeptical of why they were doing it. But if it can actually be shown that it has true commercial relevance, that might help with these kind of substance over form arguments, which is where I think some of the litigation may go.
So before we jump in, I actually want to ask one other question, which came from an audience question, and then I promise we will jump into the First and the Second Circuit opinions. Then the question sort of relates to what you were just talking about on different structures. Will this discussion have an impact on non-equity partners at law firms? This is probably a personal question in some ways, but the question was basically, could law firms get around self-employment tax by giving a non-equity partner a limited interest in profits in addition to a fixed salary? So is there some benefit to be had for law firms, or I suppose even accounting firms, from something like the Fifth Circuit opinion?
So I think what I was wondering there is, if I get even a sliver of a partnership interest, then I can't be an employee of that partnership. So would it work for law firms? I think I've got to be either an employee or I've got to be a partner, or I've got to have some structure that Jim might know of that allows me to do both. But
I don't really see this being something that will be beneficial in that context, because first, a law firm or an accounting firm can't form as a state law limited partnership. There are other types of entities, but the isolation of liability from your actions as a lawyer or an accountant are dealt with differently, and they put you in a different kind of entity. So I don't think you could then rely on CERIS, which it specifically says we're only addressing state law limited partnerships. Doesn't say what they would have done with respect to a different kind of entity treated as a partnership. But I think it would be hard to take advantage of this opinion for a service, professional service business like that.
Well, if I can add, that where the rules of the, I mean, there are like rules that apply to lawyers and accountants that would prevent that. But in Sirius, it was a consulting firm, I mean, running a services business. So once you get away out of the professions, I think Jim's 100% right about what he said. Once you get away from the like medicine and accounting and accounting, it's kind of, you know, potentially open season if you think Sirius is the law of the land for as long as that's a little bit of the difficulty with the decision, right? Is that if you're kind of saying it's all about limited liability, but that's just not enough by itself. They have sort of a viable standard across entities. But
well, and Walter, it's an interesting point, because one thing that the Rinkemeyer and the IRS's arguments had been, you have to be passive in order to qualify for the SECA exemption. And Karen, I think your research into the limited partnership rules say you don't have to be passive. You just can't have management control. So somebody who's just a worker, they do have the potential. I think even under a opinion that would be stricter than Sirius to qualify for the exception, assuming that you are referencing state law.
Interesting. Okay, let's jump into the First and the Second Circuit cases. Walter and Karen, could either one of you give us, you want to start with the First Circuit? Some background on where we are and thoughts on how the court might rule?
I can give some dates at least, and then maybe turn to Walter for something more substantive. As Walter says, Sirius jumped the gun in the tax court by conceding that it flunked the functional test, and so it raced to the Fifth Circuit. The other cases are proceeding at a somewhat slower pace. So the other two cases are Denham and Sorbonne. Denham in the First Circuit and Sorbonne in the Second. Denham is slightly ahead of Sorbonne. In Denham, all of the briefs and oral arguments have occurred, and so I think it's ripe for decision. Sorbonne, all of the briefs have been completed, but oral argument will actually happen on June 25th. So we're also hoping they'll listen to this. And so it just is a side point, but I don't want to get us too far off. In the oral arguments in Denham, most of the oral argument was about the jurisdictional issue. Is this really a partnership item? The TEFRA issue. And having listened to those oral arguments for an hour, one, I had no idea which way the judges were going to come down, but also I found myself somewhat more confused than I thought I was earlier. So I think it's anybody's guess as to how the jurisdictional issue will be determined. And we're going to do, I think maybe Walter's going to take us, rather than try to address the jurisdictional issue in 30 seconds, we're going to say, well, what's the fallout if in fact, though we don't necessarily think that's the case, but if in fact the First or Second Circuit decide they lack jurisdiction? Walter, did I set you up?
If that happens, there's an interesting sort of iteration of things that could happen. Like the First Circuit could grant in-bank review and vacate the current panel decision, and then it would just be the tax court running it. Or the First Circuit could sit it down, or the Second Circuit could sit it down on this audit question, which we're not getting into. That'd be a whole other program. Or one could do it, the other could not do it. So you could have all kinds of outcomes here. The most likely outcome probably that they won't grant in-bank review in the Fifth Circuit. That decision will stay out there, and at least one of those two circuits won't send it down on the audit question, which we're avoiding talking about. And probably, if I had to guess, we'll rule for the government. I think it's very likely that in the next several months we're going to get a conflict in the circuit. But anything is possible, right? As we sit here today, we could be back on the tax court opinion if they grant in-bank review, and both the First and Second Circuit could send it back down on the audit question. And we'd be back where we were before Sirius. So it's right now it's anybody's guess how this is all going to play out. But
Karen, one question on Denham and the fact that you listened to the oral arguments. I did not listen to the oral arguments, but from reading the press on the oral arguments, the judges seem to be a little more focused on the management issue than was the case in Cirrus. Is that consistent with what you heard?
I think at least one judge was.
Okay.
Yeah.
Well, and I guess we had
They
one
actually
judge in
did not
Cirrus
really
too.
discuss the merits very much at all, which indicated to me they probably have a good grasp of where they want to come out on the merits. And it's the jurisdictional issue that could hang things up.
Got it.
So in the First Circuit, we had that March 13 order requesting additional briefing on Denham's argument that net self-employment earnings aren't a partnership item under 6231A3. Could someone address that and what the partnership item is and what does this mean?
Well, I think, Kara, that's the thing we've been trying so assiduously to avoid. It's easy to state what the test is. It's very difficult to apply. TEFRA is a probably not well-constructed statute. So it has to be an item required to be determined at the partnership level and more appropriately determined at the partnership level. Something like that. I'm not quoting it exactly. We agreed we wouldn't speculate on it. So I think I'm going to bow out right there.
Anyone else want to jump in here?
I agreed that I was not qualified to speculate on it.
Yeah,
I'm definitely not qualified
makes,
to speculate, but Walter, let's turn to you.
yeah, that makes three of us. So I'm amazed that she got all the way through listening to those oral arguments and stayed awake. But
I did.
But yeah, I just I don't think it's clear what the answer to the audit question is. But it does throw kind of a wrench in the works because it really would be nice to have this decided on the merits, both in the First and Second Circuit. Because it could be we end up with just as serious. And so probably the audience knows this, but under the Golson rule, the Fifth Circuit's decision is only going to be valid in the Fifth Circuit. So the tax court would be free to stick to its guns in every other circuit in the country under a case called the Golson. So it would be, that's an awkward outcome in the near term. So it'd be nice, it'd be better for sort of tax law writ large if the First and Second Circuit decided on the merits and then set it back down. But at this point, it's anybody's guess. But
I think it's unlikely, but I think they could actually decide both. I mean, you could say, we're going to decide on the merits. We're also going to decide on the jurisdictional issue. I don't think there's a problem. I mean, not sure whether there's a problem with that or not. So that for review purposes, at least the merits issue would have been addressed.
Yeah.
that'd be right.
Yeah. Karen, what's the likelihood that Congress will act to clarify the meaning of limited partner? Like, is any of this that we're going through at the moment going to spur Congress on to act?
No. I mean, I think it's extraordinarily unlikely under the current administration that the meaning of limited partner will be resolved. I think it's also, and so the mess persists, and it's also it's utterly impossible that we would do something with 1411. I think extremely unlikely. So, I mean, really, this is the mess we have.
Yeah.
Karen,
If I can go, if I just want to add one planning consideration. So right now, if I was a lawyer, real lawyer, sort of the left, so I guess, I mean, my concern would be if I could do this right now under this administration, I'm probably pretty safe. Let's be honest, right? But once you put yourself in a limited partnership, you're going to be in there for years, right? Including into the next administration. And for example, in 26, you're going to file your return in 27. I mean, statute of limitations is going to expire in 30. And so on. And and you're still going to be operating as a limited partnership. So from a planning perspective, you do have to sort of, if you're outside the Fifth Circuit at least, you have to worry that this, right now it's going to be safe, but what about in 2 or 3 years? Because your partnership's going to have to keep going, right? So that's the kind of the planning tension.
And Kara, I will just weigh in there. We did have budget proposals under the Biden administration and proposed legislation that would have addressed this issue. The Biden administration budget proposal in 2020 for the fiscal year 2022 and going forward would have said LPs, LLC members, and S Corp shareholders are subject to tax, SECA tax, if they materially participate. And they also would have eliminated the material participation exemption under 1411. So that was the budget proposal. We then moved to the Build Back Better Act in 2021, and they had a slightly different proposal. It simply said, we're pulling out the active business or active partner exception in 1411. I think the reason for that was you can't make modifications to Social Security and Medicare in the context of budget reconciliation legislation. But with that legislation, that would have taken away the benefit of this structure. And Walter, going to your point with administrations, this issue was on the IRS business plan from 2014 to 2019, and then again from 2023 to 2025. It came off in the first business plan of the current administration, but it has been something that's been on the radar. I agree. I don't see it coming back on the business plan in the current administration. But I think it certainly is possible if the administration changes.
No, that makes good sense. I'm going to turn to an audience question, and then then I have a few additional. Audience question came in asking, how do passive activity rules under Section 469 affect the analysis of the definition of a limited partner? Could anyone take a stab at that?
So there were cases between 2000 and 2010 that addressed the status of limited partner for purposes of 469. The IRS was trying to rely on a regulation that said for entities other than limited partnerships, limited liability will cause you to be treated as a limited partner. And if you were a limited partner, it was harder to prove that you materially participated. All of the courts that considered the issue rejected the argument and said that given that it's a material participation standard that is at play for 469, it's really about management authority and activity in the partnership that's relevant there. The IRS ultimately conceded, and they've put out proposed regulations that would change the regulation to say it's management power. With that said, that one of the cases, I think it was Castiglia, cited one of the 469 cases, but really for something that was not crucial to the holding. I think the policies are pretty different. So I don't think there's going to be great reliance on the 469 authority for purposes of the 1402 analysis.
The only thing I would add to that is that, this is sort of obvious, but the flip side is if you don't materially participate under 469, you're probably safe under the IRS's views under 1402A13. So if you don't materially participate, you're probably good. But if you do materially participate, then you get into this morass of the cases that we've been talking about.
But if you don't materially participate, then you've got 1411.
That's true.
So
yeah, very important point.
3.8% tax.
Yeah, and a lot of this is around planning out of the 3.8% tax. That's an important point.
Interesting. Karen or Walter, if the issue is it actually makes its way to the Supreme Court, is there any indication based on earlier rulings how the court might rule?
Yeah, that's a tough. Go ahead, Karen.
Oh, I'll try to be as brief on this as possible. But one thing that the Fifth Circuit did is it missed the Moore case, and that's the 2024 case in the Supreme Court, and the Moore case cited approvingly an old 1925 case called Burke-Waggoner, which involved a entity that was treated as a partnership under Texas law, but Justice Brandeis said the Congress had the power to treat it as a corporation because it wasn't an ordinary partnership. But what's relevant here is especially the notion that's quoted in that passage then from Burke-Waggoner and Moore, saying that federal statutes, that state statutes are of kind of limited significance, and bearing on Congress's ability to tax entities. I don't know. Look, the Supreme Court majority Moore was using this for a different purpose, but I think there is a whole line of cases that say classification of partnerships and partners is a federal matter, and that there is some federal concept, and that these active limited partners were not LPs in common parlance in 1977, and that state law can't make them such.
Yeah, I agree with Karen. I think I would be surprised if they overruled Wyeth versus Hoey. I mean, of course they could, but I think that was the problem. They might try to fudge it and try to find a way to cut the baby in half, but it's hard for me to see them reversing Wyeth versus Hoey. Ideally, of course, would be nice if they just came out with a sort of black letter law that everyone could rely on across the entities. And even better, as Jim was partly alluding to, if Congress would act to clean this whole area up, that would be really the optimal result.
Yeah, of course.
Yeah, Kara,
Go ahead, Jim.
I will just say, if things go the way they have in the non-tax cases, they're likely to rule in a way that will not make me happy.
They will rule in a way that makes your life more difficult.
Yes.
So one audience question that just came in is actually a good one for us to end on today. Are there any disclosures that should be considered in 2025 returns while this issue is still pending in courts? In other words, what should taxpayers and limited partnerships be doing now to either protect themselves or plan for the future?
I was going to make an offhand comment. If the Secretary of the Treasury is content that he doesn't need to change his filing, I wouldn't think anybody needs to, but that's offhand.
I would think, so Kara, that the disclosures, I think, would be aimed at penalty protection. Generally, I think if you've got realistic possibility of success, but not substantial authority, you would want to file disclosure. As things stand right now with the Cirrus case out there, it's criticism of the as such language in the tax court case, which I have thought was not a strong rationale for the decision. I'd be surprised if taxpayers are disclosing for fear of penalties in this situation when they have a general partner entity that is really a real and vigorous entity. So I'd be surprised if taxpayers are going to start disclosing. But if Denham or Soroban comes down in a different way, that could definitely change the way people think about that.
I certainly agree.
Yeah, I agree with that too. I agree with that too.
Well, this is going to be pretty wild to watch in the coming months. Do we think we'll have this summer? Do we think we're going to get opinions? I guess not. If we're just hearing, arguing Soroban in June, then we won't probably get anything.
I think we'll have Denham.
We'll have Denham.
That's my guess. Denham comes, Bank gets denied, our bet with Walter's bet in mind, and Denham gets decided. But
then it's a decent chance we have a conflict in the circuits at that point. But,
yes.
And then will the Supreme Court take it?
So I asked if the Supreme Court, like how they might rule, but do we actually think they would take this? If there's a split, do we think the Supreme Court will take this case? It's always hard with tax cases to decide, and sometimes I feel like they take cases I don't expect, and they don't take cases I do expect. But here, if we do have a split that's on the interpretation of the term limited partner, it just feels like it's something that needs to be decided.
Well, and also it's a relatively large revenue matter. I mean, I don't have a clue as to whether they really would take it or not, but I think there is an argument that they should take it because it's a question of general import and it does have significant revenue consequences.
Yeah,
I have heard people be skeptical about them taking it, even if there's a conflict in the circuit. And I can see them waiting at least until both Soroban and Denham are decided. But it's a question mark whether they'll grant. I mean, they don't have to, and it's a question mark, really.
Yeah, I mean, they don't have to. It just seems like it does feel like one of those cases that should be decided. We should have, on a definitional question, we should have a standard definition of what the term limited partner means and how you qualify for it and how you're qualifying for this exception.
Yeah, absolutely.
I mean, to me, this is an issue where there's great confusion and where we need resolution. I really think it's the government, Congress that should be weighing in to address this. There was a study in 2001 where they addressed a bunch of situations. Tax code uses general partner and limited partner in different places. And this study by the Joint Committee said, we've got to do something. The term simply doesn't make sense anymore. So I really think that's where we need to see the change.
Yeah, absolutely. The term doesn't make sense and it's not well defined. And partnerships are so heavily used and much more heavily used today than they were 20, 50 years ago.
For sure.
Absolutely. Absolutely. Yeah.
Well, thank you very much. This was fantastic. I personally learned a lot. I'm always a little fearful of partnership topics because they are hard and they are challenging, but I really appreciate you guys coming on today, sharing your thoughts and your advice and your opinions. And thanks to our viewers for participating and asking questions and keeping everything going along. So thank you all. We look forward to the next one and have a fantastic rest of your day.